How did a $60 billion powerhouse collapse into one of the largest frauds in history, wiping out $74 billion and thousands of livelihoods in its wake? This is the story of Enron, one of the largest corporate scandals in American history. In the archives of corporate America, few stories are as infamous as the rise and fall of Enron Corporation. Founded in 1985, Enron emerged from the merger of Houston Natural Gas and Internorth, two natural gas pipeline companies, under the leadership of Kenneth Lay, who had been the CEO of Houston Natural Gas. Enron quickly established itself as a major player in the energy sector. The company's initial focus was on natural gas pipelines, but it soon expanded its operations in response to the deregulation of energy markets in the early 1990s. Lay, along with Jeffrey Skilling, who joined the company as a consultant before becoming chief operating officer, transformed Enron from a traditional energy company into an energy trading powerhouse. Enron's growth in the 1990s was nothing short of meteoric. The company's reported revenue skyrocketed from $13.3 billion in 1996 to $100.7 billion in 2000, an astounding increase over 750% in just 4 years. This expansion rate of 65% per year was unprecedented in the typically slow-growing energy industry. By the end of 2000, Enron's stock was trading at $83.13 per share, and its market capitalization exceeded $60 billion, 70 times earnings and 6 times book value. Investors and analysts alike were captivated by Enron's apparent success and innovative business model. Enron's perceived brilliance earned it numerous accolades. Most notably, Fortune magazine named Enron America's most innovative company for 6 consecutive years, from 1996 to 2001. The company seemed to embody the promise of the new economy, seamlessly blending traditional energy assets with cutting-edge trading and risk management strategies. Enron's business model and growth: diversification into various industries. Enron's business model extended far beyond its original focus on natural gas pipelines. The company aggressively diversified into various industries, including energy trading. Enron became the largest wholesaler of gas and electricity in the United States. Risk management. The company offered sophisticated financial products to help other businesses manage their energy price risks. Broadband services. In the late 1990s, Enron attempted to create a market for bandwidth trading. Water services. Through its subsidiary Azerix, Enron entered the water utility business. Paper and pulp. Enron owned and operated several paper plants. International energy projects. The company invested in power plants and other energy infrastructure in developing countries, including India and Brazil. This diversification strategy impressed Wall Street, contributing to Enron's reputation as an innovative, forward-thinking company. Enron Online, revolutionizing energy trading. In October 1999, Enron launched Enron Online, an electronic trading platform for energy contracts. This platform quickly became a cornerstone of Enron's operations. By the mid-2000s, Enron Online was executing nearly $350 billion in trades. The platform's success bolstered Enron's image as a technology-savvy company at the height of the dot-com boom. The deception behind Enron's success. While Enron appeared to be a paragon of corporate success, the reality was far different. The company's spectacular growth and profitability were largely illusory, propped up by a complex web of accounting tricks and outright fraud. Mark-to-market accounting, a double-edged sword. At the heart of Enron's deception was its use of mark-to-market accounting. This method, which Enron adopted in 1992 with SEC approval, allowed the company to record the projected future value of certain contracts as current revenue. Here's how Enron exploited this accounting method. The company would enter into a long-term energy contract. Enron would immediately book the entire estimated value of the contract as revenue, even though the actual cash flows would be spread out over many years. If the revenue from the contract later proved to be less than estimated, instead of recording a loss, Enron would transfer the asset to an off-the-books corporation, hiding the loss from investors. This practice allowed Enron to claim billions in revenue that had not yet, and in many cases, would never materialize. As one Enron competitor observed, if you accelerate your income, then you have to keep doing more and more deals to show the same or rising income. Special purpose entities, hiding debt and losses. Complementing its mark-to-market accounting was Enron's extensive use of special purpose entities, or SPEs. These were essentially shell companies created to fulfill specific financial objectives. While SPEs can serve legitimate business purposes, Enron used them primarily to hide debt and toxic assets from its balance sheet. Some notable SPEs used by Enron include Chewco, named after the Star Wars character Chewbacca. This SPE was created in 1997 to buy out CalPERS' stake in another Enron joint venture called Jedi. This allowed Enron to keep Jedi's debt off its books. LJM1 and LJM2. These partnerships, managed by CFO Andrew Fastow, were used to hedge Enron's investments in other companies. The Raptors, a set of 4 SPEs named after the velociraptors in Jurassic Park, used to hedge Enron's investments. These hedges were largely illusory, as they were backed by Enron's own stock. By 2001, Enron had used hundreds of SPEs to hide billions of dollars in debt. When the true nature of these entities came to light, Enron was forced to restate its financial statements, reducing reported profits by $586 million for the years 1997 through 2000 and increasing reported debt by $2.6 billion. Key figures in the scandal: Kenneth Lay, founder and chairman. Kenneth Lay was the founder of Enron and served as its chairman for most of the company's existence. Lay was known for his political connections, particularly to the Bush family. He cultivated these relationships to help shield Enron from regulatory scrutiny. Despite claiming ignorance of the fraudulent practices at Enron, evidence suggested that Lay was at least aware of the company's precarious financial position. In August 2001, he received a now famous memo from Sharon Watkins warning of accounting irregularities, but he failed to act on this information. Jeffrey Skilling, CEO and architect of Enron's transformation. Jeffrey Skilling joined Enron in 1990 and quickly rose through the ranks, becoming president and chief operating officer in 1997 and CEO in February 2001. Skilling was the driving force behind many of Enron's innovative and ultimately fraudulent business practices. Skilling was known for his aggressive, results-at-any-cost management style. He implemented a performance review system known as Rank and Yank, where the bottom 15% of employees were fired each year. This created a cutthroat culture where employees felt pressured to do anything to show results. Andrew Fastow, CFO and mastermind of financial deception. As Chief Financial Officer, Andrew Fastow was the architect of many of the financial structures that allowed Enron to hide its true financial condition. Fastow's dual role as both Enron's CFO and the manager of several SPEs that did business with Enron was a glaring conflict of interest. Fastow's complex financial maneuvers helped Enron report ever-increasing profits while hiding billions in debt. Through his management of off-the-books partnerships, Fastow personally pocketed tens of millions of dollars. Sharon Watkins, the whistleblower. Sharon Watkins, an Enron vice president, emerged as a key figure in exposing the company's fraudulent practices. In August 2001, Watkins sent an anonymous memo to Kenneth Lay warning of accounting irregularities. The memo stated, "I'm incredibly nervous that we will implode in a wave of accounting scandals." Watkins' warnings went unheeded by Enron's leadership, but her role as a whistleblower was crucial in bringing the company's fraudulent practices to light during subsequent investigations. The role of Arthur Andersen. Arthur Andersen, one of the Big Five accounting firms at the time, played a significant role in enabling Enron's fraud. As Enron's auditor, Andersen was responsible for verifying the accuracy of the company's financial statements. However, the firm repeatedly signed off on Enron's dubious accounting practices. Andersen's failure was partly due to conflicts of interest. In 2000, Andersen earned $25 million in audit fees from Enron and $27 million in consulting fees. This dual role as both auditor and consultant compromised Andersen's independence. Moreover, many of Enron's accounting staff, including its chief accounting officer, were former Andersen employees, creating a revolving door that further blurred the lines between auditor and client. The collapse of Enron. Skepticism from analysts and investors. The beginning of the end for Enron can be traced to early 2001. On March 5, 2001, Bethany McLean published an article in Fortune titled, "Is Enron Overpriced?" This piece was one of the first to publicly question Enron's opaque financial statements and unsustainable business model. McLean's article noted that Enron stock was trading at 55 times earnings and that analysts didn't know how the company actually made money. She wrote, "How exactly does Enron make its money? Details are hard to come by because Enron keeps many of the specifics of its sprawling empire to itself, and the company's financial statements are nearly impenetrable." Stock price decline. Enron's stock price, which had peaked at $90.75 per share in August 2000, began to decline steadily throughout 2001. Key events in this decline included: on August 14, 2001, Jeffrey Skilling abruptly resigned as CEO, citing personal reasons. This unexpected departure raised red flags for many investors and analysts. On October 16, 2001, Enron reported a $618 million third-quarter loss and disclosed a $1.2 billion reduction in shareholder equity, partly related to partnerships run by Fastow. The company's stock price plummeted to $20.65, down $5.40 in one day. On October 22, 2001, the SEC announced it was investigating Enron's accounting practices. The stock fell further to $20.65. On November 8, 2001, Enron announced that it had overstated earnings dating back to 1997 by $586 million, and that it had $3 billion in off-the-books debt. The stock price fell to $8.41. SEC investigation. The Securities and Exchange Commission launched a formal investigation into Enron's accounting practices on October 31, 2001. The investigation focused on the company's use of off-balance sheet entities and related party transactions. As the investigation progressed, more details of Enron's fraudulent activities came to light. The company was forced to restate its financial statements for the previous 4 years, revealing that it had overstated earnings by $586 million and understated debt by billions of dollars. Dynegy's failed acquisition attempt. In a last-ditch effort to save the company, Enron agreed to be acquired by its smaller rival, Dynegy, on November 9, 2001. The proposed deal valued Enron at about $9 billion in stock. However, as more information about Enron's true financial condition emerged, Dynegy became increasingly wary of the deal. On November 28, 2001, Dynegy announced it was backing out of the merger agreement, citing breaches of representations, warranties, covenants, and closing conditions. Bankruptcy filing. With no other options left, Enron filed for Chapter 11 bankruptcy protection on December 2, 2001. At the time, it was the largest corporate bankruptcy in U.S. history, with Enron reporting $63.4 billion in assets. The company's stock, which had traded at $90.75 at its peak just 16 months earlier, closed at 26 cents on the day of the bankruptcy filing. This represented a loss of over 99.7% of the stock's value. Aftermath of the scandal. Impact on employees and shareholders. The collapse of Enron had devastating consequences for its employees and shareholders. Job losses. Over 20,000 Enron employees lost their jobs when the company filed for bankruptcy. Pension losses. Many Enron employees had invested heavily in company stock through their 401k retirement plans. In total, employees lost more than $2 billion in pension funds. In a particularly cruel twist, just as the company was collapsing, many employees were blocked from selling their Enron shares due to a temporary freeze on the 401k plan. Shareholder losses. In total, Enron shareholders lost $74 billion in the 4 years leading up to the company's bankruptcy. This included millions of small investors who had bought Enron stock directly or through mutual funds. Legal consequences. The Enron scandal resulted in numerous criminal prosecutions. Andrew Fastow pleaded guilty to 2 counts of wire and securities fraud. He was sentenced to 6 years in prison and agreed to forfeit $23.8 million in assets. Jeffrey Skilling, convicted in 2006 on 19 accounts of fraud, conspiracy, and insider trading. He was initially sentenced to 24 years and 4 months in prison and fined $45 million. In 2013, his sentence was reduced to 14 years as part of an agreement that mandated large restitution payments to victims of the collapse. Skilling was released from federal custody in February 2019 after serving more than 12 years. Kenneth Lay, found guilty in 2006 on 10 counts of fraud and conspiracy. However, Lay died of a heart attack in July 2006 before he could be sentenced. Because he died before he had the chance to appeal his conviction was vacated. Other executives. 16 people pleaded guilty for crimes committed at the company, and 5 others, including 4 former Merrill Lynch employees, were found guilty at trial. Dissolution of Arthur Andersen. Arthur Andersen also faced severe consequences for its role in the Enron scandal. Indictment. The firm was indicted in March 2002 for obstruction of justice related to its shredding of documents pertaining to the Enron audit. Conviction. Andersen was found guilty in June 2002, effectively ending its ability to audit public companies. Surrender of licenses. The firm surrendered its CPA licenses and its right to practice before the SEC in August 2002. Job losses. The collapse of Arthur Andersen led to the loss of 85,000 jobs worldwide. Overturned conviction. Although the U.S. Supreme Court later overturned the conviction in 2005, by then the damage was done. The firm had lost most of its clients and had ceased operating. Lessons learned and regulatory changes. The Enron scandal led to significant regulatory changes aimed at preventing similar corporate frauds in the future. The most important of these was the Sarbanes-Oxley Act of 2002. Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act, often simply called SOX, was signed into law by President George W. Bush on July 30, 2002. Its key provisions included creation of the Public Company Accounting Oversight Board, or PCAOB, to oversee the audits of public companies. Requirements for CEOs and CFOs to personally certify the accuracy of financial reports. Enhanced disclosure requirements for off-balance sheet transactions. Stricter rules for auditor independence, including prohibitions on certain types of consulting services for audit clients. Increased criminal penalties for securities fraud and white-collar crime. Protection for corporate whistleblowers. Requirements for companies to establish internal controls and procedures for financial reporting and to document, test, and maintain those controls and procedures to ensure their effectiveness. Increased focus on corporate governance. The Enron scandal highlighted the importance of strong corporate governance. In the wake of the scandal, many companies increased the number of independent directors on their boards, strengthened the role and independence of audit committees, implemented more robust ethics training programs, established clearer channels for employees to report suspected wrongdoing, reforms in accounting practices and financial reporting. The scandal led to increased scrutiny of accounting practices, particularly the use of mark-to-market accounting, the disclosure and accounting treatment of off-balance sheet entities, the role of auditors and the potential conflicts of interest in providing both auditing and consulting services, long-term impact on the business world. Changes in corporate culture and ethics. The Enron scandal served as a wake-up call for many corporations, leading to greater emphasis on ethical business practices, increased focus on long-term sustainability rather than short-term profits, more robust internal control systems, enhanced transparency in financial reporting, improved risk management practices, increased scrutiny of off-balance sheet transactions. While off-balance sheet transactions can serve legitimate business purposes, Enron's abuse of these structures led to greater caution in the use of special-purpose entities, more stringent disclosure requirements for off-balance sheet arrangements, increased investor skepticism towards complex financial structures, enhanced regulatory oversight of unconsolidated entities, enhanced role of whistleblowers. The actions of Sharon Watkins in the Enron case highlighted the crucial role that whistleblowers can play in exposing corporate wrongdoing. This led to stronger legal protections for whistleblowers, as mandated by the Sarbanes-Oxley Act, creation of whistleblower hotlines and other reporting mechanisms in many companies, increased public recognition of whistleblowers' importance in corporate governance, enhanced procedures for internal investigations of whistleblower complaints. Key figures that illustrate the scale of the Enron scandal include shareholders lost about $74 billion in the 4 years leading up to Enron's bankruptcy. Enron's stock dropped $90.75 from its peak to 26% on its bankruptcy filing. Approximately 20,000 employees who lost their jobs due to Enron's collapse. Enron employees lost approximately $2 billion in pension funds. Enron's reported assets at the time of its bankruptcy filing were $63.4 billion, making it the largest corporate bankruptcy in U.S. history at the time. Legacy of the Enron scandal. The Enron scandal resulted in one of the largest bankruptcies in U.S. history at the time. With $63.4 billion in assets, Enron's collapse in 2001 was a watershed moment that shattered public trust in corporate America. While later surpassed by other major failures like WorldCom, a $103.9 billion bankruptcy in 2002, Lehman Brothers, a $691 billion bankruptcy in 2008, and Washington Mutual, a $327.9 billion bankruptcy in 2008, Enron's bankruptcy remains one of the most significant due to the scale of fraud involved and its far-reaching consequences. It fundamentally changed corporate governance practices and financial regulations in the United States. Ongoing influence on business ethics discussions. The Enron scandal continues to be a central case study in business ethics courses and corporate training programs worldwide. It serves as a cautionary tale about the dangers of corporate greed and a lack of oversight, an example of how complex accounting practices can be used to mislead investors, a reminder of the importance of strong corporate governance and ethical leadership, a demonstration of the potential consequences of prioritizing short-term gains over long-term sustainability. In conclusion, the $74 billion in shareholder losses, thousands of ruined careers, and the far-reaching regulatory changes that followed serve as a reminder of the importance of ethical business practices, transparent financial reporting, and robust corporate governance.